Alrighty, welcome to another Taxes and Retirement Live. I am Andy Panko, owner of Tenet Financial. Glad you can be here. Thank you. Today's topic will be all about, let me just get rid of this, will be all about health savings accounts, or HSAs. Before we start, let me do the video disclosure here. Just give me a second. Alrighty, this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Thank you. Let me just see. Okay, comments are working. I see Cody Garrett saying it's live. Yes, it is live. And for those of you who are interested in commenting, feel free along the way, post comments. I can see them here, and I can choose to toggle on your comment on the screen like this to show it to everyone. If you're interested in having your name shown, for example, this comment just says, hello, hello. I don't know who this is from on my end. It just says Facebook user. If you're interested in having your name shown, there is an opt-in feature you can do. I can save, I'll send that in a different link. Or there's a previous post I posted up a week or two ago about it. You have to allow Facebook permission to share your profile picture and name with this StreamYard system, which is the software I'm using to stream. Not a big deal if you don't, but if you want to, like Dave Fultz, for example. Hi there. Dave has opted in such that when I broadcast and show the comment up on screen, you can see his Facebook profile pic and name. All right, dad jokes. As you know, dad jokes are my thing. Let me do a quick start with my few jokes for the night. First, why do scuba divers fall backwards into the water? Because if they fell forwards, they'd still be in the boat. Not great, but they get better, I promise. Where's the next one at? Right. How do you make a hanky dance? You put a little boogie in it, of course. And finally, I got a special surprise for this one. Why did the octopus beat the shark in a fight? Because it was well armed. Wait for it. Oh, there's an octopus who's well armed. He's going to win in a fight right there. That guy. He's got conviction and boxing gloves. Okay. So one other comment you may have noticed, Cody Garrett in the group, right here, Cody Garrett, who liked the intro music to this week's Facebook Live. So Cody is another fellow financial professional. He and I met by way of this group, actually, early on when I started it back in April, I think it was, of 2020. We don't work together at the same company or know each other, professionally. It's all through this group. But Cody is now one of the moderators in the group, which means he could approve comments. He can, if and when anyone escalates, spam-looking comments to him, he's able to delete them out. And he can also help approve, new members who request to join. So nice warm welcome to Cody. He's a super sharp cat. Those of you have, you've probably seen his name and responses around a lot. He's got his own blog, measuretwicemoney.com. Awesome level of content and education there. But the group has hit the point that I can't keep up with it on my own, unfortunately. As much as I try to the last minute, started with nothing in April. It's pushing, getting close to 7,000 people at this point, growing by a few hundred a week. And the posts per day now are, 10, 20 posts per day. I just can't do it, unfortunately. So, I don't want there to be a loss of quality or responsiveness. Cody, super appreciative of the help. Again, very sharp guy, knows his stuff. He's helping with help me work through this all, and we'll see where this thing goes. Who knows how many members there ultimately be, and if and when we need to broaden out the pool of admins in it. But so you'll see me not as responsive or not replying to every single post anymore. I just can't, as much as I enjoy it. Plus my day job, I am a living, breathing retirement planner / investment manager, and my business is growing quite well, better than anticipated. Actually, frankly, have a bit of a waiting list. So, I'm trying to balance a lot here. But anyway, so that's Cody. Welcome, Cody. Thank you again for all the help, and everyone's going to see a lot more of him throughout the group. And if for whatever reason, if I were to think Cody wouldn't be able to maintain the level of quality responses, or he also has a very educational approach. Neither of us are here selling anything, as you can tell. We just want to educate and inform as much as possible. Cody's very much the same mindset. So anyway, Welcome, Cody. Thank you. That's that. I appreciate it. All righty. And yes, Jackie, and don't, my screen gets a little buggy sometimes in the videos. I think you can still see and hear me. Cody was actually interviewed and spotlighted in a podcast episode for Financial Planning Association. So thank you, Jackie, for posting that here. If anyone's interested in learning more about Cody and his story, you can check out this link here. Cool. All right, so tonight's topic, health savings accounts, otherwise known as HSAs. One of the best retirement savings vehicles there are from a tax efficiency standpoint. And I have slides to show and discuss this and why I mean that. Unfortunately, not everyone is able to get an HSA, or if you have one from a previous job or health coverage where you were able to have one to contribute, you may not be able to contribute anymore now. Once you have one, you can always keep it, but you can't necessarily always contribute. So what is the HSA at a super high level? It stands for Health Savings Account. It's a special type of investment account where, in that sense, sort of similar to a brokerage account or IRA or whatever, but specifically you need certain types of qualifying health insurance to be able to contribute into an HSA. There are limits around how much you contribute each year. We'll go over that. There are strict restrictions around how you can take money out. There's sort of loosely like a flex spending account, or FSA. It's a special type of account you may have had or have through your employer where the money can only be used to pay for qualified medical expenses. HSA is kind of the same concept. So we'll discuss that. So, at its core, it's a medical expense reimbursement tool / account. But stepping back and viewing it more holistically, it's a fantastic long-term, super tax efficient investment vehicle. You can get some really good growth really tax efficiently with it. All right, let me pull up the screen share here. I got some slides. Give me a second here. I'm still getting used to the software. It's only my third week using it. All right, here we go. Got it. Yes, there it is. All right. Let me just keep this up here so I can still see comments. Sorry, it's a little jittery because I'm just dragging around the screen in the background here. Quick comment, Facebook users, anyone have a link to the upcoming Wednesday schedule? Yeah, it's at the top. When you go to the group, it's called an announcement. It's a post I made where it's pinned to the top, so it's always at the top, that has a full schedule. I have it scheduled all the way out to the end of May, I believe. So it's always there, hanging out at the top of the group. You can see it. All right, cool. So let's start with the tax benefits of an HSA and why it's so good. We'll start with a regular brokerage account. Just a little compare and contrast table here. There's typically three main types of tax efficiency you can have. One is, does the contribution itself save you taxes? Meaning, can you deduct the contribution on your tax return? Two is, once money's in the account, are you taxed along the way? Or does any sort of gains, interest, or dividends just sort of, tax get deferred, or is it eventually tax-free, or are you taxed as it happens, in the year it happens? And third is when you take the money out, are the withdrawals tax-free? So let's start with a regular brokerage account. Right off the bat, no, there's no deductibility. There's no tax savings to put money in. It's just like a bank account. You get money, you pay tax on that money, wherever you got it from, like your wages or whatever, and you put the money into your account. No tax savings. Is the growth in the account tax deferred or tax free? I say maybe here because it's not tax free. Actually, maybe to further complicate things. But when you get paid dividends or interest throughout the year in a regular brokerage account, it's taxable in that year, and assume you have to pay taxes on it. If your income is low enough, you can actually get away with zero tax on some form of investment income. That's a whole other topic, but for all practical purposes, assume you will be taxed on your dividends and interest in the year you earn them. And then as far as capital gains, so you buy something low and its price goes up over the years, you're not actually taxed on that gain until you sell that position. At that point, you realize the gain and have to pay tax on that year. So that's why I'm saying it's tax deferred, maybe tax-free, maybe depends on the rest of your taxability. Anyway, and taking money out, same sort of story. Depending what you have to do, if you sell a position at a gain, you're going to pay tax on that gain. If you sell a position at a loss, you can actually save yourself some taxes because that loss can offset your other income. So taking money out of these accounts may or may not be tax savings or tax-free, or actually, help you reduce your taxes elsewhere throughout your tax return. So that's a regular brokerage account. Next is a traditional IRA. The big selling point there is the money you put in, assuming your income is below certain levels, does get you a tax deduction. So you put in $6,000, you reduce your taxable income for that year by $6,000, saves you some tax. Is the growth tax-free? No, but it is at least tax-deferred. So it doesn't matter what happens inside the account, whether you get dividends, interest, or capital gains, you're not taxed on any of it inside the account. You're only taxed when you take dollars out, which leads me to this third point. Again, any dollar you take out is regular taxable income. It is not tax-free, those withdrawals. Red thumbs down. Okay. Quick comment. Yeah, so Mark, and thank you, Mark, for your picture and name here. Mark's just pointing out that regular brokerage account earnings could be tax-free. For example, municipal bonds, almost all of them, the interest on almost all of them is tax-free at the federal level. Gains are not tax-free, but at least the interest is in the vast majority of cases. There are some municipal bonds that aren't tax-free federally, but some are. So yes, good point, Mark. Thank you. All right, next account type is Roth IRA. And this is sort of the flip, the opposite of a traditional IRA. Whereas a traditional IRA can get you a tax savings up front, a Roth IRA does not. You put the money in with regular after-tax dollars, just like you do with, with a regular brokerage account. The gains and all the growth along the way, just like an IRA, doesn't matter what happens inside the account along the way. There's no taxability of dividends, interest, or gains that happen inside the account. When you take money out, only then may things be taxable. Now, the whole selling point, the whole beauty of IRAs is if you hold the account long enough, and if you're of a certain age or meet a host of various other withdrawal criteria, which is a whole separate topic, if you meet these conditions, then all the money eventually comes out tax-free, penalty-free. Whether it was gains, whether it was dividends, whether it was interest, whether it was your own contributions, it all comes out tax-free. So that's the big, big positive of Roth IRA. Again, sort of like the flipped profile of a traditional IRA. And finally, HSA or health savings account, green thumbs up across the board. So trifecta of tax benefit. So like a traditional IRA, contributions are tax deductible. They save you tax on the way in. Like Roth IRAs, there's no tax on anything that happens inside the account. Dividends, interest, gains, it just sits there and the account grows. You're not taxed in the year of that activity. And like a Roth IRA, tax-free withdrawals, assuming those withdrawals are used for qualifying medical expenses, which I'll touch on a little bit down in this presentation. So that's why HSA is the only account out there that has all three, basically tax-free, tax-free, tax-free across the board tax benefits. And now to sound like a 2-bit infomercial, but wait, that's not all. There's one more, fourth possible tax benefit, which is also consider payroll tax deduction. So what are payroll taxes? When you work, you have a job. Not only do you pay regular income tax, but you pay payroll taxes, aka FICA taxes, FICA, which are the taxes you pay into the Social Security and Medicare systems. Those come out straight out of your paycheck. If you have an HSA and it's funded through your employer, or you have it as a result of the health insurance you have through your employer, your contributions to your HSA could also save you these payroll taxes if you contribute, through your employer. Now, not all employer-sponsored plans will do this. It's only specifically if it's what's called a Section 125 cafeteria plan, to break out some technical IRS speak, which most employer plans are, but point is not all of them. But generally speaking, if you have an HSA through your employer, you can likely save some Social Security and Medicare tax to boot on top of the other tax trifecta. So quadruple win for HSAs, which is why they're such splendidly good tax efficient savings vehicles and long-term investment vehicles, because you can let these things sit for decades. It's not like an FSA where it's use it or lose it with now some a few $100 of carryover. You don't have to spend it at all. You can just keep pumping money into it, and you can spend it down decades later, in retirement, in your 60s, in your 70s, in your 80s. We'll touch on that. One thing to keep in mind, this little chart I'm going through here, this is just with regards to federal taxes. what makes tax planning and doing taxes so difficult is state taxes. So there's 50 states, each of which, some don't have income tax at all, but those that do, they all have slightly different income tax treatments. And all the states don't need to align their tax processes and rules with those of the federal government. For example, there's 2 states that I'm aware of, one, my state of New Jersey, and also California. They do not give you a state income tax deduction for HSA contributions. In effect, they basically make you treat HSAs like any other regular brokerage account. No deduction on the way in. I believe in theory, you're supposed to claim any gains each year as taxable income. Now in practice, I doubt many people do, but I think the right answer is you're supposed to, again, for California, New Jersey taxes. And then on the way out, money's treated like a brokerage account. Maybe it was taxed, maybe it wasn't. It depends what happened inside the HSA for you to free up the cash to take it out. Anyway, okay, so that's taxability. That's why HSAs are such great tax-efficient savings/investment vehicles. And again, they do not need to be used in the year of. You can contribute, and just let it sit there, let it bake, invest it for the long term. So you may be asking, and I don't have a slide for this, but how and where do you open one? Well, you can't just open it at any broker. Like if you want to open an IRA or a regular brokerage account, you can go to Vanguard, Schwab, Fidelity, TD, E-Trade, whatever. Only certain custodians are called HSA custodians. Fidelity is a big one. There's also Optum Bank. There's HSA Bank. There's Health Equity. There's a whole bunch. Those 4 I just rattled off are the big ones. But basically shop around and see, like picking any other custodian. You want to shop around for service, how good their website is, what their fees are, if any, what types of investments they allow you to do. This brings me back to my point. So you can invest in traditional, stock, bond, and mutual fund type investments in most HSAs. You're only limited by what the HSA custodian gives you for your investment options, like an employee retirement plan, like a 401k. Sky's not the limit. They're going to give you a menu of a couple dozen funds that you can choose from. HSAs will potentially be the same. Fidelity, I think, gives you, you can invest in a lot of Fidelity. I don't know if they let you do single stocks or just a whole roster of mutual funds, but you have a lot of investment options at Fidelity. So point is, you can sit on this HSA for decades, invest it as aggressively or as conservatively as you want, let all this free tax stuff, tax-freeness just kind of build and let all this growth accrue over time and eventually take it out tax-free. Phenomenal product. All right. Moving on, just looking here, questions, okay. So yeah, this person, Fidelity lets you buy anything, even stocks. Good to know, yeah. So it sounds like if you have your HSA at Fidelity, it's like any other normal brokerage account there, I guess, based on this comment, you can buy whatever you can invest in a normal brokerage account, you can invest in an HSA, it sounds like. All right. Sorry, just looking at another comment here. Dave Foltz, getting a little ahead of things, but HSAs on the Affordable Care Act exchanges are more expensive than comparable plans that are not HSA. Any idea why this is? No, I don't, unfortunately, Dave Foltz, but that is a good question. Okay. And Cody just pointing out, some HSA custodians require you to have a minimum cash balance while others have no minimum cash balance. The Fidelity HSA allows you to purchase securities just as you would in a taxable brokerage with no cash minimum. Yeah, that's a good point. I know I work with some clients where they have, I think it's a $2 million cash minimum in their HSA as dictated by the HSA custodian that they have, or that was chosen for them by their employer. You may not have a choice where you go necessarily. But good comment, Cody. Sounds like not all HSA custodians require you to have a cash minimum. And Facebook user saying White Coat Investor, which is a blog, has a great comparison of HSA custodians. So maybe worth checking out. I'm not personally familiar with that, but thank you for that information. Okay, I see someone just posted a bunch of other questions. Hold that thought. I will be addressing those towards the end regarding Cobra and ACA Marketplace. All right, moving along. So who is eligible to contribute to an HSA? Now, technically, anyone can open one. You don't need to prove anything. You just simply go to a custodian and open it, but you can't contribute unless you're eligible to contribute. So there's really no point in opening it unless you're eligible to contribute. So what do you need to do to be eligible to contribute? And just for those of you who are interested in more, I'm frankly not an expert on every single in and out about HSAs. If you want to know more, always go to the IRS publications. The one for this is IRS publication 969. That's the one that summarizes health savings and investment vehicles, one of which is the HSA. There's a lot more detail. You should always go to the IRS publications. That's the source of all this stuff. So to the extent you have more questions, after this, or questions I can't answer, because again, I don't know all the nuances to these, that it's definitely worth checking out that. So in order to be able to contribute, a few things have to happen. Biggest one right off the bat, you need to be covered by what's called a high deductible health plan, otherwise known as HDHP. We'll touch on that more in a bit. That's basically a health insurance policy where the deductible, the amount you have to pay first before coverage kicks in, is quote unquote high. And the next slide will define what dollar amount of threshold constitutes high. You have to have no other health coverage except that which only provides benefits for certain conditions. In other words, you have your health insurance through your high deductible health plan, right? You can't have another secondary policy on top of that. Your only coverage could be this qualifying high deductible health plan, with some exceptions. If you have one-off special coverage, for example, you have a specific disease where that disease is not covered by your primary insurance, you have coverage that only covers that disease, you can have that in addition to your high deductible health plan. You can have things like vision, dental, those are unrelated. It's really just your base medical coverage that needs to be your only traditional medical coverage. Again, vision, dental, those are different. Long care, disability policies, those are different. It's really just your broad-based medical coverage. You can only have one, and it can only be this qualifying high deductible health plan. You cannot be enrolled in Medicare. So for most people, once you hit 65, you're done being able to contribute to an HSA. You can always keep the HSA you already have if you already have one, but you can no longer contribute. That's the point of this slide here. The exception is if you're still working and you're still covered by your employer-sponsored health insurance, and if that insurance is qualifying, you can keep that. You don't need to sign up for Medicare when you're 65 if you still have this other coverage. In that case, fine, you could potentially still keep contributing to your HSA. But let's assume you're retired by 65. Once you hit 65, sign up for Medicare, you cannot contribute to an HSA anymore. And I'll touch a bit more on this because there's actually some timing you gotta factor into if you do delay your Medicare beyond 65. You cannot be able to be claimed as a dependent on someone else's tax return. That's a little technical, but basically, if you're an adult and you're not financially, someone else pays for more than half your expenses, someone else could potentially claim you as a dependent on their tax return, you cannot qualify to contribute to an HSA. And finally, now this one, there's a lot of caveats and ifs, and frankly, I'm not 100% clear on all these. But if you're not eligible to contribute to an HSA if you're covered by a flex spending account or health reimbursement account. But there's exceptions. A few, and again, I took this right from publication 969. This isn't the comprehensive list, but these seem to be the big ones. If your FSA or HRA only cover those specific other conditions I just mentioned, like specific disease, like vision only, like dental only, that's fine. But if your FSA or HRA covers your broad-based medical coverage, it reads to me like you're not eligible to contribute to an HSA. If you suspend your FSA or HRA, it reads to me that you can then contribute. Or if you have an HRA, and this is, I want to say quite common, but happens sometimes, as a retiree benefit, some employers will fund a health reimbursement account for you that you can use in retirement. So technically you have the account while you're still employed, but you can't access it yet because you're not retired, then it's okay. You can have an HRA in that case and still be eligible to contribute to an HSA. Clear as mud, I know. So again, I'm not an expert on all the ins and outs of all these little caveats and tweaks, but these are the big ones I saw from publication 969. The big one is really you need a high deductible health plan. You can't have other coverage. You cannot be enrolled in Medicare, and you can't be a dependent on someone else's tax return. So what is a high deductible health plan? Well, here's the dollar limits, and these are for 2021. It needs to have a minimum deductible. If you're an individual, so the coverage is only for you, the deductible needs to be no less than $1,400. If it's a family plan, and family plan is simply you plus at least one other, doesn't matter if it's you plus one or you plus five, a family plan is a family plan just the same. So in a family plan, your deductible needs to be at least $2,800 to qualify as a high deductible health plan. There's also maximum out-of-pocket amounts you need to hit to, or be under, or not go over, I should say, to qualify as a HDHP. For individual coverage is $7,000. For family coverage is $14,000. Now, those maximum out-of-pocket amounts do not include your premium payments or payment for services that are out of network to the extent your plan has a designated network of providers. So like if you're paying $1,000 a month for your premium, that's $12,000 a year. That $12,000 does not count towards your out-of-pocket, unfortunately. It does not count towards the $7,000 or $14,000. Out-of-pocket expenses are just things once on top of your premium. Basically anything else you pay out of pocket, co-pays, co-insurance, things like that, those all count towards your maximum out of pocket. All right, just scanning the comments here quickly. So there's a question from someone about contributing to an HSA from an IRA versus a regular brokerage account. Hold that thought. I do have a comment on that later. Here's a good one. Can you use any qualified custodian? I have an account through Health Equity for my previous employer. Now I have an HSA through my new insurer, Anthem. Can I still contribute to my Health Equity account? Yeah, you should be able to. Check with Anthem and confirm. I guess in theory, the health insurance provider can restrict you to which custodians you use. Check with them first. If they say, no, you're free to go wherever you choose, then you can simply open up an HSA somewhere else and transfer over your assets, just like opening a new brokerage account somewhere. You open the account, transfer assets over from your old account. You can do the same thing with HSAs, but check with your with Anthem first and see, or your employer if you're now employed somewhere else. See if they limit you on which custodians you can use. Good question. Okay, so this is what qualifies as a high deductible health plan. Again, you need to have a minimum level of deductible and a maximum level of out-of-pocket payments. Contribute. How much can you contribute? So again, assuming you're eligible, so you have a high deductible health plan, you're not on Medicare, you're not someone else's dependent, etc. You don't have other coverage. How much can you contribute in a year? These are for 2021. These limits change a little bit each year, with inflation. So if you are under 55 by the end of the calendar year, technically the end of your tax year, but for almost everyone, they use the calendar year as their tax year, but whatever. We'll just assume, end of the calendar year. So if you're under 55 and you have an individual health coverage plan, it only covers you, you can put in $3,600 for the year. There's also a catch-up provision, just like with IRAs and 401ks and stuff. If you're over a certain age, you can put a little more in. If you're 55 or older, you can contribute an additional $1,000. So keep in mind, I said 55. With 401ks and IRAs and 403bs and stuff, the catch-up age is 50. With HSAs, it's different. It's 55. So don't confuse the two. I don't know why it's different. It just is. So if you're 55 or older and have an individual plan, you can contribute $4,600 for the year for 2021. You can contribute all on January 1st or spread it throughout the year. If you're covered through an employer, they may restrict you to how much you can put in, and whether you do it monthly, quarterly, whatever. But if you're on your own, not through work, you can dump it all in one shot if you want to. Other big thing to keep in mind with these contribution limits. If you are covered by, you get your insurance through an employer and they contribute to your HSA, some amount to your HSA, that gets factored into your total annual amount. Quick example. So you're under 55, you have individual coverage, your annual contribution max is $3,600. If your employer puts in $2,000 on your behalf, you can only put in another $1,600. You can't do $3,600 on top of the employer. This is a shared limit. Keep that in mind. That's important. I'll discuss what happens later if you contribute too much. I've seen this happen. It happens frequently, unfortunately. Employer contributes. The employee wasn't quite sure how much the employer contributed, or the employer, last minute at the end of December, dumped some money into the account, that the employee wasn't counting on. And so the employee sort of filled up the rest. Well, guess what? Now the employee is over because the employer just dumped in a little bit more, such that they're now over $3,600 or whatever their limit is. You can undo that excess. I'll touch on that. Not the end of the world, but it's a hassle, honestly. So try to coordinate closely with your employer if you have coverage through your employer, and figure out from them how much you're going to contribute to the HSA throughout the year, so with a good amount of certainty what the difference is that you can put in yourself. Okay. Just comment here. So my employer deducts contributions monthly from my paycheck on a pre-tax basis and puts it into the custodian they work with, which is Fidelity. Nice choice. Not much flexibility. So it sounds like, through your employer, employers can limit you to who you use, but if and when you move or you're on your own, you have discretion over who you choose. Maybe your insurer can restrict you, but I don't think that's common. Getting back to these limits. If you have a family plan, $7,200 for the year. If you're 55 or older, there's also the $1,000 catch-up. Now, here's a little cool point. If you're married and you file a joint return, and each of you are 55 or older by the end of the year, and you each have family coverage, you can each put $1,000 in extra as a catch-up. Now, here's like a neat little twist. So if only one of you is actually covered, so let's say spouse A is still working at 56 years old and spouse A has coverage that covers both spouses, A and B. I don't know why, but the IRS treats it that in that case, both spouses, including the spouse who's not working, let's say, who's just covered by the other spouse's insurance, both those spouses qualify to make their own $1,000 catch-up contribution. However, both spouse needs their own HSA. So spouse B, who doesn't directly have his or her own coverage, he's just covered by the other spouse. Spouse B can still open up and would need to open up his or her own HSA separate from spouse A, so that each of them could put $1,000 into their respective HSAs as a catch-up. As far as who takes the $7,200, you can allocate that kind of how you choose. So again, this is in publication 969. If you want to read more, I'll leave it there, but just know that if you're married, both of you are 55 or older, and you have family coverage in your HSA, you each may be able to put in $1,000 catch-up on top of the base $7,200 maximum contribution. Alrighty, next. So contributions, I mentioned this happens a lot with people who are on Medicare or starting Medicare. Remember, once you're enrolled in Medicare, you are no longer eligible to contribute to an HSA. You can still have an HSA if you already have one that you funded prior to starting Medicare, but you can no longer put new money into your HSA going forward once you're enrolled in Medicare, starting in the month you're enrolled in Medicare. So quick example here. Let's assume you turn 65 in April and you start Medicare right in the month of April when you turn 65. You can contribute January, February, March. You're able to make an HSA contribution. The way it works is basically prorated. So if your annual contribution is $3,600 plus the catch up, so that will be $4,600 divided by 12. You can do $383.33 per month, basically, for these 3 months that you are eligible. So you would be able to contribute for 3 months, effective April, i.e. the month you start Medicare. You are no longer eligible to contribute for the rest of that year. Straightforward enough, right? Here's where things get weird with Medicare. If you start later than age 65, Medicare will automatically backdate your Part A coverage up to 6 months. They'll backdate it either 6 months or back to the month of your 65th birthday, whatever is less. Part A is the hospital coverage. Not to make this a Medicare lecture, but Part A covers hospitals. Part B is regular doctor outpatient coverage, and Part D is drugs, prescription drugs, not the crazy black market stuff. So Part A, if you sign up for Medicare after your 65th birthday, my screen's a little glitchy, but I think I'm still running. You can still hear me. The glitch will stop shortly. If you sign up after your 65th birthday for Medicare, they will backdate your Part A up to 6 months or back to your 65th birthday, whatever is less. let's see an example. That glitch is still here. That's annoying. Let me, there we go, gone. So let's assume you turn 65 in April, starting with the same scenarios before, but you don't sign up for Medicare until July. So what is that? That's 4 months, I guess 3 months after your birthday. You think you're golden because I delayed until July, therefore I can contribute to my HSA all the way up through June, and I have to stop for July. That's not accurate, unfortunately. When you sign up for Medicare in July, they will backdate your Part A coverage. Again, the greater of 6 months. The lesser of 6 months, or back until the month of your 65th birthday. So in this case, when you sign up in July, they're backdating your Part A coverage to be effective in April. So that means you need to have some foresight here. If you know you're going to delay, you have to plan ahead and do this backdating in your mind. And you're like, okay, even though I'm not signing up till July, I need to stop contributing in March because my Part A is going to be retroactively effective starting in April. So I cannot contribute from April onward. Again, if this does happen to you and happens somewhat commonly, you can undo excess contributions. I'll touch on that at the end, but just avoid it if you can and save yourself a lot of headache. This is common for people who continue working past the age of 65 and don't sign up for Medicare right away because they're still covered by their employer's coverage. Completely fine. But when you do eventually stop, whether it's 65 in 1 month or whether it's 75 or later, whenever you eventually stop working and lose your employer coverage, your Medicare is going to start. Your Part A will get backdated up to 6 months. So plan accordingly with your HSA contributions and cut them off ahead of time as necessary. Alrighty. So now you know what HSA is, how to get money into it, how much you can get into it, how to get money out. Again, HSAs, in my opinion, are best used for long-term, tax-free, super tax-efficient investment savings / growth vehicles. In your 40s, don't open an HSA and just empty it out each year, paying for that year's medical expenses. Now, life happens. You may need the money, do what you got to do. But if you have any control, any option, don't use it right away. Just let this stuff sit and bake and let it grow for decades. So how can you get money out? So HSAs are technically like reimbursement accounts. It's not like with an FSA, for example, you may get a debit card or like credit card type thing attached to it so that you can go directly pay for medical services or prescription drugs or whatever with your FSA card. The money comes right out of your FSA. I honestly don't know if any HSAs have that type of arrangement. Or if it's solely just a reimbursement. I've always seen it done on a reimbursement basis. You just simply take money out. The onus is on you to say, yes, this was for a qualified expense. You need to have the receipt. If and when you're audited, definitely have the receipts. But otherwise, it's kind of the honor system. Well, I don't want to say that. It's up to you to take out money when you want to reimburse yourself for eligible expenses where you have the receipt. So what are eligible expenses? They need to be, quote unquote, qualified. Now, at a super high level, basically any medical expense that you'd be eligible to potentially deduct on your tax return is qualified. I don't want to put the list here because it's huge, but it's dental, vision, almost all sorts of medical, acupuncture, alcoholism treatment, prescription drugs, hearing aids, lots of stuff, even improvements to your home. If you need a ramp put in because you're wheelchair bound, that's a qualified medical expense that you can deduct in your tax returns. Hence, it's also eligible for HSA reimbursement or to be reimbursed from HSA. I don't know the specifics, but the CARES Act of 2020, the Coronavirus Relief Act, did broaden the amount of things that are now eligible medical expenses for tax deductions. So lots of over-the-counter drugs used to not be eligible expenses. Like you go buy some Advil at CVS or whatever, you cannot deduct the cost of that Advil as a medical expense on your tax return. Well, guess what? This year you can. Regular OTC drugs, aspirin, Advil, whole host of things are now eligible to be deductible medical expenses on your tax return. Hence, they're eligible to be reimbursable from your HSA fund as well. I don't know when that ends. I forgot to look that up. I don't know if that's a 2020 special, this broadened list of what's eligible, or if that's permanent until it's otherwise changed. But Might just be this year. I'd have to look that up. So user here saying their HSA does come with a MasterCard. Okay, cool. So that makes it more easy than, more efficient. I guess you just pay straight with the MasterCard. Money comes right out of your HSA. Keep the receipts just the same, because you will need to substantiate your expenses, your HSA withdrawals, if and when IRS comes knocking. Let me take a question here. I have an HSA based with family coverage for me, my husband, and 2 kids. Husband has no insurance. When he starts Medicare at 65 in 2022, I will still have family coverage for me and the 2 kids. I can still keep my HSA, correct? Does his being on Medicare have any impact? So yes, you can still keep your HSA. You can always keep it. Even if you're no longer eligible to contribute, you can always keep what you already have and take the money out for qualified expenses. Does your husband being on Medicare have any impact? In some ways, yes. So actually, it might not. So he's no longer eligible to have an HSA, but it sounds like he didn't in the first place, or he's not eligible to contribute, I should say. But you're still going to have family coverage. Just because he has to drop off because he's going to be covered by Medicare now, you'll still have family coverage technically, because there's more than one of you still covered, you and your 2 children. So you should still have the same contribution limit, just the same, $7,200 plus a catch up if you're over 55 for you. So no, it won't impact it in that sense. So no, unless I'm missing something, I don't think there'd be any direct impact by your husband dropping off your policy and joining Medicare. Good question. Because again, you'd still have family coverage since there's going to be 3 of you, you plus 2 others still covered. Good question. All right. So just going back to this. So what's eligible for Medicare expenses? Basically anything that's eligible as a deductible medical expense on your tax return, but with one big exception / exceptions. The health insurance premiums themselves are not able to be reimbursed with an HSA. So if you don't have an HSA and you're paying health insurance premiums each month, those premiums are deductible, potentially deductible on your tax return. That meets this condition 1. But for HSA, they're not. So for example, you have health insurance through work, you pay $1,000 a month. You cannot take $1,000 a month out of your HSA to turn around and pay for your health premiums. Similarly, you stop working, you retire, you get laid off, whatever. You get an Affordable Care Act policy, the healthcare exchange. You cannot use an HSA to pay for the premiums of that policy. The premiums have to be paid, which is regular money. They're not HSA reimbursable. There's some exceptions. Long-term care insurance premiums can be paid with HSA money. COBRA. So if you have insurance through an employer and you have a separation of service, whether it's voluntary departure, whether you're fired, whether you're downsized / laid off / right size, whatever you want to call it, you can continue your coverage from work. Typically, it's for only up to 18 months under this government law called COBRA. It's an acronym. You can pay for COBRA premiums with HSA money. If you're unemployed, not just unemployed, but unemployed and receiving unemployment insurance, then you can pay for your monthly health insurance premiums with HSA money. Again, you got to be getting unemployment benefits. You can't just be unemployed. So like you can't voluntarily quit work and say, I'm unemployed, let me use my HSA to pay for my health insurance. No, you have to actually be getting unemployment benefits. And big one, as we touched on, Medicare. Medicare premiums can be, again, you can't contribute to an HSA anymore once you enroll in Medicare, but your base Medicare premiums can be paid with HSA money, but your Medigap or supplemental Medicare premiums cannot. So base Medicare is Part A, is typically premium. There's no premium for most people. Part B, it's about $150 a month is the standard premium. Part D varies, depends on the plan you get. Again, Part D is prescription drug coverage. Your base premiums, you can pay with an HSA. But if you get what's called Medigap or supplemental plan, it's additional insurance that sits on top of your Medicare, and covers other things that base Medicare does not, you cannot pay for those Medigap supplemental premiums with HSA money, unfortunately. Kind of weird, but can't do it. If still on COBRA for 18 months, again, COBRA is continuing your employer coverage, but you're paying yourself out of pocket now after you separate from employment. If I'm on COBRA for 18 months, can I still contribute to my HSA even though not employed? Yes, I believe so. Not 100% certain, but fairly confident. Yes, you can still contribute, so long as that health plan you have is still a qualifying plan in that it's high deductible. It's a high deductible health plan, which presumably it is. If it was high deductible while you had it at work, all COBRA is you continuing that exact same coverage, but you're paying out of pocket full freight for the policy, whereas your employer probably subsidized a pretty healthy chunk of it. COBRA is just you paying on your own, plus actually 2 or 3% additional surcharge on top of it. But anyway, point is, it's the same coverage you had at work is what you have on COBRA. So yes, if it was qualifying at work, should still be qualifying along COBRA. And I'm fairly certain, yes, you can still contribute to your HSA while you're still covered by that policy extended through COBRA. Good question. Okay. All right. So that's what qualified medical expenses are. Do I have another comment here? Oh, sorry. Let me get this up. Yep. Okay. So sort of some final thoughts, and feel free to dump your questions on me at this point. So other things to keep in mind and consider. Remember I said ideally you don't want to just use your HSA to pay for that year's expenses. Just pump money in it, let it sit, let it invest, let it grow, because it's the most tax efficient vehicle you can get your hands on. Take advantage of it. Long-term growth, maximize the growth in this tax-free gift of an account type. So you can save receipts. So for example, here's what I'm getting at with this first point. Let's assume you sign up for an HSA this year because you become eligible this year, and you start contributing this year and every year forward, assuming you continue to be eligible every year forward. You can save receipts. So let's say you sign up today, start contributing today. Next month you have some surgery, you got to pay $1,000 out of pocket. You can keep that receipt. As the IRS allows it now, and this is always subject to change, as it's allowed now, you can keep that receipt from your surgery this year and pay for it in 30 years. So how old am I? I'm 43. So I can have an HSA, I can let it sit. When I'm 73, I can pull money out of my HSA to pay for the $1,000 I paid for my surgery this year when I was 43. That's what I mean. Like, you keep receipts, let the money grow. Don't use it now. Really maximize the tax-free growth you can get in this thing over the long term, and then use it in your later years, in your retirement years, to pay for potentially decades-old expenses. Again, you don't need to keep receipts. For decades, you can start paying for stuff at the time. Like I said, Medicare premiums you can pay for with HSA. So that right there, once you hit 65 and get on Medicare, you're going to have at least, today's dollars, it's $150 a month for Part B at a minimum. You have that expense right there you're going to have, plus your Part D, plus, your other out-of-pocket expenses. So anyway, so that's a neat trick. You can keep receipts forever until the IRS changes it. And I don't know if and when they will, but as of now, you can reimburse yourself from decades ago, as long as you have the receipt. And again, the cost or the service or the medical purchase needs to have happened after you're first eligible to contribute to an HSA. So like, you can't have receipts from when you were 15 and not in a HSA. It needs to be from when you had an HSA forward. Keep receipts for those things. Okay, so if you do ever contribute too much, whether it's because you have a plan on your own and you simply mess up and put too much in, or more commonly, you have a plan through an employer and your employer contributes some, you contribute some. Oops, you both kind of aren't paying attention to what the other's doing and you get too much money in there, you can take it out. If you don't, you're going to have a 6% penalty for every year that excess is in there. There's a 6% penalty on the excess. How do you take it out? It's just like an excess IRA or Roth IRA contribution. Even though the calendar year ends December 31st, you have until you file your tax return, so typically April 15th of the following year for most people, you have until you actually do your taxes and submit them to take out any excess from the prior calendar year. And it's common sense if you think about it, because the IRS realizes you may not know exactly how much went in there during the year. So they give you until you do your tax return and actually have all the facts and figures about the previous year. You then find out, oops, too much was contributed. Let me take some out. You can do that. As long as it's taken out before you file your return, you don't have to pay that 6% penalty. How do you take it out? Basically call up your custodian, or probably on their website they have a way to do it. There's going to be a form or a process or whatever. Just say, hey, I put in $200 too much. Can you send me out, distribute out $200 from the HSA, code it as an excess contribution so that on the tax reporting form that shows all the money's coming out, they'll say, yes, this was a refund of excess. It wasn't some other, regular distribution. All right. Question, do you need to keep an explanation of benefits too? Yeah, good question. I don't know. I would think it can't hurt. I don't know that it's necessary, but you bring up a good point, whoever this is. It would be logical that it would only help, not hurt, to have your explanations of benefits, because that'll detail what the procedure was. I guess it may also depend, like if you have the receipt and it's to, dentist Joe Smith, it probably doesn't matter then, because it's pretty clear it's to a dentist, and I doubt the IRS would ever challenge you that what else would you have used this for if not some sort of qualifying dental expense. Or if you go to like CVS and you have a receipt, the receipt's going to say right on it, aspirin, insulin, prescription, whatever, then that's sufficient. But yeah, for medical procedure, it may not hurt to have an explanation of benefits. I don't know that it's necessary, again, especially if the receipt says like Dr. such and such, but I don't know the answer. Can't hurt, but sounds like a lot of work keeping those things for however long. Okay, other things here. So again, the beauty of an HSA is that it grows in tax-free, grows tax-free, comes out tax-free if used for a qualified medical expense. What if you take money out for something other than a qualified medical expense? Well, in that case, you're always free to take money out, but if it's not for a qualified medical expense, you will have to pay ordinary income tax on it, just like taking money out of a tax rate is that year. That's what you're paying tax on, or that's your tax amount, and a 20% penalty if you use it for a non-eligible, medical expense. Here's a little bit of a nicety. Once you're 65, that 20% penalty goes away, but you'll still have to pay tax on it if you use the money for something other than a qualified medical expense. So worst case, you're 65, whether because you forget or you don't have any other medical expenses to spend this money on for whatever reason. Yes, you can take the money out. There will be no 20% penalty, but you will have to pay regular tax on it on the year you take it out. But then you can do whatever you want with that money. So tax, but no penalty once you're at least 65. If you're under 65, tax plus 20% penalty to use HSA money for something other than qualified medical expenses. Follow-up question to withdrawing excess contributions. How do you treat the earnings on excess within the year? It's like taking excess out of an IRA or Roth IRA. The amount of the excess, so let's say you put in $200 excess by mistake, you take that out, but guess what? In the time it was there, that 200 had 10% growth such that it's now 220 that's coming out. The $200 is non-taxable. That's just a return of your original contribution. The $20 gain is taxable. It'll be ordinary taxable income. Now, I don't know if it's taxed in the year you get it back or the year that it was for. So for example, you do an excess contribution in 2020. You realize in April 2021, you're doing your tax return. Oops, you take it out in April 2021. I don't know if that $20 of gain is taxable in 2021 or taxable in 2020. The reason why I don't know is if it's an excess 401k contribution, for example, I'm pretty certain the gain is taxable in the year you take it out. But if it's an excess IRA or Roth IRA contribution, I think it's the gain is taxable in the year the contribution was for. So two different treatments. I don't know where the HSA lies, but ultimately the gain is taxable as ordinary income to you. Not sure which year though. Comment from Cody Garrett. Like IRAs, HSAs have an April 15 contribution deadline. Yes, good point. Right. Thank you, Cody. Yeah, thank you. So like IRAs, for example, you don't know exactly what your income is going to be. So you may not know during the calendar year where you fall relative to like the income phase out thresholds and stuff. So therefore, the IRS lets you make a 2020 contribution to your IRA up until your tax return filing deadline, April 15th. HSAs are the same thing. You can contribute for 2020 up until April 15th, 2021, or whenever you file your return. Just like you can undo an excess up until then, you can also contribute up until then for the previous year. Good point, Cody. Thank you. Okay, other cool trick with HSAs. There's a once-in-a-lifetime thing you can do called a qualified HSA funding distribution. This is where you can take up to your annual contribution limit from your traditional tax-deferred IRA and transfer it into your HSA. Tax-free, penalty-free, whatever. The reason why this is so cool is because your IRA, let's assume you took a tax deduction for it originally. Yay, that's the good part. The bad part is whenever you take money out of your IRA, eventually it'll all be taxable as ordinary income. Well, guess what? You can take potentially, what's it, $7,000, $8,000 out of your traditional IRA, transfer it to distribute it to your HSA. That's not a taxable distribution from your IRA. The money just simply comes out. Not simply, you got to account for it in your tax return. But the point is, money that otherwise would have been taxable in your IRA, you can basically just transfer over to your HSA. Once it's in there, it's now in this sweet tax-free world where eventually it'll come out tax-free. Big win. There's a few caveats, and this is all spelled out in IRS publication 969 again. Again, once in a lifetime, you can do this. Not for 1 year. You can only do one single transfer in your lifetime. So if you're going to do it, make sure you're transferring as much as possible. Like, don't do it if you're covered for a full year by a plan. Don't do 11 normal contributions, for 11 months, and then just do one monthly contribution as this IRA transfer. No, go all out. Do a full year contribution if you can by way of this IRA transfer. Also keep in mind, again, this is limited to your annual contribution limit, inclusive of whatever your employer contributed. So you're still capped by that. The other big gotcha is that in order to do this, you have to continue to be eligible to contribute to an HSA for 12 consecutive months after the month you do this once in a lifetime qualified HSA funding distribution. For example, if you do this qualified HSA funding distribution in December 2020, cool. You can potentially contribute your full 2020 amount in that 1 month by way of this IRA transfer. But you need to continue to be consecutively covered by a qualifying high deductible health plan for all 12 months of 2021. If for whatever reason you're not, like you lose coverage halfway through the year for whatever reason, now you're retroactively, you did an improper transfer, and there's going to be tax consequences. I forget exactly what they are. I probably should have looked this up beforehand. I think you got to treat it like an excess distribution, maybe put some back. But point is, be certain to the best of your knowledge that if you're going to do this once in a lifetime IRA transfer, that you will have qualifying high deductible health plan coverage for the 12 months following the month of your IRA transfer. I'll leave it there. Again, publication 969 if you want to read all the gory details, but that's a big gotcha to look out for with that otherwise really cool, typically unknown secret about IRA transfer. I saw someone ask about 401k. Can you take the once in a lifetime contribution from your 401k, or does it have to come from an IRA? Has to come from an IRA as of now. Maybe this will change at some point, but currently it's IRA only. And it needs to be just a regular IRA. A SEP, SEP IRA or simple IRA are not eligible to do this. So if you have one of those self-employed or small employer plans, again, SEP or simple IRA, can't do it from that. It needs to be just a regular IRA or a rollover IRA, which is functionally a regular IRA, just the same. Those are the only ones you can do this qualified HSA funding distribution from, not employer plans like 401ks or whatever. Final comment I want to touch on is what happens when you die? What happens to your HSA? As much as HSAs are the awesomest tax-efficient savings/investment vehicle out there, they are not good wealth transfer tools from a tax perspective. So if you have an HSA, when you die, if and when you die, if you're married, your spouse is able to make that HSA his or her own and pick up where you left off. He or she can then use it for qualified medical expenses the rest of his or her life, etc. That's fine, no problems. The tax magic still lives on in the hands of your spouse. If you leave an HSA to anyone else, so if you're not married or you are married and designate some other non-spouse beneficiary, the tax is punitive. The tax magic goes away at that point. Whoever inherits it, other than your spouse again, whoever inherits it, the entirety of the account needs to be distributed in the year of your death, and it's all treated as regular taxable income in the hands of the beneficiary. So not a good wealth transfer tool at all from a tax efficiency perspective. Unless you're leaving it to a spouse, then it's fine. Otherwise, Now, if you want to leave it to a charity, that's fine, because charities don't pay tax to start with. So, and this gets into some higher level sort of estate and wealth transfer and charitable giving planning. If you have an HSA you don't plan on using and you're charitably inclined, leave it to a charity. But generally speaking, delay using your HSA as long as possible, but do try to spend it down while you're alive or while one of you or your spouse is alive, to really squeeze the most juice out of the tax awesomeness of the HSA. All right, I think that's it. Yeah, that is it for my slides. Yep, okay. I'll leave that up for now. Let me bring just my face. Oh, there's the glitch. Oh, there we go. Okay. All right, I will do questions. Let me just scroll up and see kind of what I missed here. Currently have a child covered by my high deductible health plan, presumably a dependent child. I incur a qualified medical expense this year related to the child. Can I reimburse myself in the future when the child is an adult not under my care any longer? Ooh, yeah, I don't know. You can reimburse yourself for anyone, for spouses' expenses or your dependents' expenses. So while the child is still your child, definitely. When the child is not, I don't know. To be safe, I would say assume not, but honestly, I'm not sure about that question. I'd say don't try it. You'll have plenty of opportunities in your own life, I would assume, to pay for expenses, to reimburse for expenses. Good question, creative thinking. I don't know the answer, unfortunately. I would lean to say assume you can't, but I don't know that for a fact. All right. Isn't the IRS going to be suspicious if you withdraw based on a 30-year-old receipt? Will you have to demonstrate that you did not take that same money out when you incurred the expense originally? Will they be suspicious? They shouldn't have any grounds to be. Whether you had the procedure or the expense 30 years ago or 30 seconds ago, it doesn't matter. An expense is an expense. As the tax code is written now, completely allowable. So no, they shouldn't be suspicious. Now, will you have to they do not have reason to be suspicious because they allow this. Will you have to demonstrate that you did not take that same money out when you incurred the expense originally? Good question. I don't think you'd have to demonstrate it. But so here's my answer to that. You're going to want to keep your receipts with the tax return of the year where you took distributions out and claim those expenses. So if you take $3,000 out this year to pay for $3,000 of expenses, attach the receipts to that year's tax return, so you don't mess yourself up and try to double dip and use those expenses again in the future. So I think that safely answers your question, and that's safely, that's a safe process to do. So you don't do it accidentally, double dip with expenses. But no, I don't think they'd make you prove you. I don't know this for a fact, but I don't know that they'd make you prove you didn't already deduct it, but you will want to have your tax returns showing what you deducted in prior years and therefore attach receipts to that. So I think that's the safest way to go about it. Good question. All right. But if you move money from your IRA to your HSA, that contribution is not tax deductible, right? Good question. So yeah, right. Let me think about that. So are you actually missing out? Because then you're not getting the savings of the tax deduction you'd otherwise have if you did just contribute to your HSA straight away. I guess the analysis would be, so let's assume that's true. Let's assume you're foregoing the tax deduction you'd otherwise get. I don't know this off the top of my head, but you're foregoing the tax deduction you'd otherwise get if you would have just made an HSA contribution straight away. But what you're gaining is you're saving yourself the tax you're otherwise going to have to pay on that IRA when you'd eventually take it out. And not just the tax on that withdrawal itself, but as we discuss in this group all the time, the other sort of hidden taxes that may get triggered or prompted by you having higher gross income from taking IRA withdrawals, like Medicare premiums are based on your gross income. So your IRA withdrawals can jack up your gross income, which could put you into an income level where you have higher Medicare surcharges or premiums to pay. So yeah, so you may miss out on the deductibility of that because, no, I take that back. Assuming the IRA contribution in the first place was deductible, that's where you got your tax savings up front when you put the money into your IRA, right? So no, you're not giving up the deduction. You still got your deduction there on the way in. Now you're getting yourself a deduction on the way out by transferring the money from your IRA to your HSA. But good question. Now, if your IRA is only after-tax money, meaning you did not get deductions for it when you put it in, that's a different story. Then yes, to the extent that's the money you transfer to your HSA, then sure, you're giving up the deductibility of it. Good thought. Thank you for bringing that up. Cody Garrett talking about tax forms. IRS form 8889 reports HSA contributions and distributions. Yes, it does. Yeah, because so he's commenting on that 30-year question. So yeah, anyone who has an HSA, if you never look at your tax return, it's worth doing. Form 8889 is the one you use to record your HSA contributions and deductions, distributions for the year. Thanks, Cody. Yep. So you will need to keep records showing your HSA withdrawals. Yes, your form 8889 shows that, and you'll get like brokerage statements that would show it as well, or custodial statements, and the form 5498-SA. I forget what it's called. That's what you get from your custodian. That's the official tax reporting form that you use to populate your tax return. That form 5498-SA, I think, is what the custodian, like Health Equity or Fidelity or HSA Bank, will send you each year, showing the distributions that you took. Yep. Tommy Ranieri, you'll need to keep records showing your HSA withdrawals. Is the once-in-a-lifetime qualified HSA funding distribution per person? Question mark. Each spouse can transfer into a single HSA, or over 2 years, maxing out each annual contribution. If each spouse has his or her own HSA and his or her own IRA, and each spouse is eligible to actually contribute to his or her HSA, then yes, you can. like the example I gave earlier, where there's a married couple, only one person works and has a family coverage through work that covers both spouses. Each spouse can't do the full, $7,000 or whatever. You can only do the $7,200 collectively for the family plan. Plus, each spouse can separately do $1,000 catch-up contribution, but each spouse needs his or her own HSA. So then for each spouse to also do this IRA magic transfer, each one needs their own IRA where they can transfer to their own HSA, but only up to their annual contribution limit anyway. In this example, one spouse can do $7,200 plus the $1,000 catch-up. The other spouse can only do the $1,000 catch-up. If each spouse has his or her own individual plan that makes each eligible for their own $3,600 contribution plus catch-up, then sure, then they can both do this $3,600 once in a lifetime IRA transfer plus potentially the catch-up, if they're 55 or older. Good question. Is that once in a lifetime IRA contribution to the HSA deductible as well? Yeah, so I touched on this earlier. Assuming the IRA was deductible when you put the money in the first place, yes, that's where you got your tax deduction. You're not going to get another tax deduction when you transfer, because that will be double tax deducting that contribution, which isn't allowed. But you got the deduction initially when you first put money into the IRA. I heard heirs can self-reimburse past expenses from the deceased owner. No idea. I'm not saying it's not accurate. I haven't heard that. Again, I'm not the Osiris of this. I don't know everything about HSAs. That would surprise me if that's true. It's possible it's true, but I have not heard that. So I can neither confirm or deny, but that sounds really generous if that is allowed. And I should scroll forward. So Cody Garrett saying for the decedent, and decedent is just fancy tax speak for person who died. For the decedent's final tax return, yes. So I guess, Cody, you're responding to whomever this question belongs to. Okay. So yeah, I guess assuming Cody's right, there's your answer, whoever Facebook user is here. All right. Final comment / question. Ooh, 9:13. We got a good one. I wasn't expecting that much participation. Maybe because I rambled a lot. That's why it went so long. Anyway, I attended a presentation by Fidelity where they showed a tool to record your expenses as you go. You should be able to pay yourself years later using that record keeping that you did years prior on Fidelity platform. Sure. So yeah, if your HSA custodian has tools like that allow you to neatly and easily account for stuff, great, do it. Otherwise, you're kind of on your own to log it, and definitely keep receipts and attach receipts to the tax returns for the years where you actually take distributions. All right, that is it for today. Thank you all. Next week's topic, I got a special guest, Christian Osa, friend of mine, local guy here in New Jersey. He's a partner in Wolf Osa Laws, and an estate planning legal firm here in central New Jersey. He will be talking about the main estate planning docs you should have, will, medical power of attorney, advanced medical directive, and a few other things. Estate planning is more than just, people think estate planning is, yes, I have a will, my estate planning is done. Not that simple, right? I mean, that's part of it. That's a vitally important document. But estate planning is more than just the 4 to 5 legal docs that Christian's going to be talking about next week. So he's really just focusing on that. We'll touch on trusts somewhat. Now, trusts there's boatloads of different trusts. Christian will be talking about the basic sort of living trust, revocable living trust that's quite common. We're not going to get into the meat and potatoes of these other off the beaten path, special charitable trust and special needs planning trust and things like that. That's not next week. But anyway, point is estate planning is a lot more than just legal docs. And I did a video on that on my YouTube channel. I discussed it again in one of these lives. But Christian next week is a lawyer, living, breathing lawyer. He'll be talking about the legal doc process and to some extent trust and estate planning. So good one. You'll definitely want to join for that. Quick check other comments. No, I don't see other comments. Cool. All right. Thank you all for joining. Hope you enjoyed it. I will see you in the group. If not, I will see you next week in next week's live. Take care. Have a good week.